Good afternoon and welcome to the January 2023 Executive Committee meeting of the Board of Education Retirement System. Today is Thursday, January 19th, 2023, and the time is 1:02 p.m., the fastest we've ever started a meeting. As a reminder, please note that the committee meeting is being recorded and will be posted to the BERS YouTube channel for those who cannot attend. I'll start the meeting by calling the roll. Cherie Gibson.
Present.
Anthony Giordano.
Present.
Right. John Matarich.
Present.
Donald Nesbitt.
Present.
Russell Buckley.
On behalf of Chancellor David A. Banks and CFO Sarita Scott, I'm present.
Right. We have a quorum. I'd also like to note for the record that alternate executive committee member Gregory Faulkner is in attendance, and that board members Allison Hirsch and John Dorsa are also in attendance. The first item of business is to consider the minutes from the December 2022 Executive Committee meeting, a summary of which was included in your packets. May I have a motion to consider?
So moved.
Thank you. May I have a second?
Second from John.
Thank you, John. Any discussion on the December 22 summary executive committee meeting minutes?
I'm not going to abstain just simply because for obvious reasons, I haven't had a chance to review a lot of this material and I wasn't there. But if you need to, so I'm going to abstain unless that poses a problem for the adoption.
Understood. Thank you, Tony. Any further discussion on the minutes? May I have a
This
motion?
is Cherie.
Yes.
This is Cherie. Not a discussion, Joe. Just note that I was in attendance, and it's not noted as one of the alternate trustees
All right.
that was present.
We'll make that change. So, subject to the change of noting the alternate member in attendance, any other discussion on the December 22 Executive Committee meeting minutes? All right. Then noting that one change to the record, may I have a motion to approve the minutes?
So moved.
Russ.
Thank you, John. In the second,
Second.
Russ? All right, thank you, Donald. Any final discussion? All right. Not all those in favor, please say aye.
Aye, Russ.
I, Cherie.
I Donald.
Absolutely. Any opposed? All right. Any abstentions? Noting that
Noted.
absolutely. Thank you, Tony. The motion carries. So committee members should have received an updated agenda this morning on a time-sensitive issue related to a recent fund approval. That being said, the first items on the agenda are discussions on individual securities or investment funds for consideration, the discussion of which belong in executive session. May I have a motion to enter executive session?
So moved. Donald Nesbitt.
Thank you, Donald. May I have a second?
Seconded, Tony.
3 seconds.
All right, thank you. Tony, any final discussion? All those in favor of entering executive session, please say aye.
Aye, Russ.
I, Cherie.
Hi, John.
Hi, Tony.
Thank you.
I Donald.
All right, any opposed? The motion carries. We are now in executive session. Karen, can you please?
Okay, recording has resumed. Antonio, you may go ahead.
All right, thank you. First report out in executive session, the board discussed negotiations on a private equity investment. The board also approved a commitment to a opportunistic fixed income fund. The board also approved a commitment to a private equity fund. So the next item on the agenda is the preliminary Q2 FY 2023 performance report. I actually wanted to talk about a little bit something different first, because unfortunately we were not able to, we lost quorum at the board meeting, and so there were a few items that I wanted to discuss with the new executive committee members, given that we got 2 new members and an additional new alternate. So I wanted to go through, give you a bit of context for BERS, kind of the executive committee as a whole, and I discussed that a little bit at the previous during the board meeting, but I'm going to give some background on the current division of current responsibility. So in December 2022, the board passed a resolution giving the BERS Executive Committee authority to approve certain fund investments. And as a condition of this authority, BERS investment strategy has to report to the board on a quarterly basis on overall performance and progress towards meeting program goals. The full board of trustees still retains authority over the major investment program decisions, so the approving of the investment policy statement, asset allocation, hiring investment consultants, and approving active fund investments and over $250 million in public markets and over $50 million in private markets. One of the big things, though, and we really like to discuss kind of the overall long-term goals. And I think the right balance between executive committee delegation and full board allows the bigger board to focus on those long-term goals while being able to do the month-to-month decision making. So long-term target return is 7% annualized. I imagine all of you know that, but just for context for the new committee members, our funded ratio target 80 to 100%. As of June 30th, 2022, the market value of assets, so our market value of assets funded ratio is around 98%, so 97.9%. That's from a high of 121% in the previous fiscal year. And making sure that we're incorporating the investment policy statement objectives in the investment process. The BERS trustees last set the current asset allocation in 2020, in April of 2020, to help meet our 7% return target over the next 3 to 5 years. Broadly speaking, the 47% in public equities, 27% in public fixed income, 26% in alternative assets. We also have economically targeted investments with no target, but can be up to 2% of assets. And then also we maintain a no cash policy, but can allow up to 5%. So the current allocations, as you can see, this is as of 12/31. We are underweight public equity and public fixed income because of the drops in public markets. So we are slightly overweight in alternative investments. So that includes private equity, real estate, infrastructure, and opportunistic fixed income or private credit. We had 50 basis points in economically targeted investments. And then right now we're at as of 12/31 at 1.13% cash. For those of you who attended the meeting on Wednesday, you saw as of June 13 numbers. These are as of 12/31. So the fund is close to $8 billion, 7.93. And our fiscal year to date at the time was about 67 basis points of return over those months. This month has been incredible for the private markets. I think we're total, 4.5%, total, 3.5 to 3.6% for the month in return. But as of 12/31, we were at 67, preliminary 67 basis points. That's in difference between the reference portfolio, which is 70% U.S. equity, 30% U.S. bonds. The global reference portfolio, which is 70% the MSCI ACWI, 30% U.S. fixed income, and the policy PME benchmark, which substitutes public markets for our private markets. Over the longer period of times, we've outperformed both all three of those portfolios, those benchmarks. Again, for those who have not been on the committee, last quarter, the executive committee approved 5 funds in October 2022 through December of 2022. You'll see here the amount, the managers and funds, and also the authority. So again, the authority that the executive committee has, re-ups, so successor funds in private markets, new private market funds at or below 50 million, and then new public market funds above $250 million. All right. Through Q4 2022, I think private equity, real estate, and infrastructure were all in range of their targets for total commitments for the year. For the private equity, that does not include the discretionary emerging managers, but each private equity, real estate, and infrastructure, we all were in the target range for total commitments that were set at the beginning of the year with the annual pacing plan. OFI was slightly below its target, and even with this new one, obviously we approved a new commitment, but for the year, that was the only asset class where we did not reach the range of or within range of our target. In addition to manager approvals, we also talk a lot about the executive committee had many discussions on kind of broader policy, new projects, and the like. So some of the new projects and searches were the variable tax deferred annuity, global listed infrastructure search that was completed last summer. The executive committee also serves as the proxy committee and corporate governance. So we discussed excluded securities and approving the shareholder engagement plan, trustee education and planning. So presentations on bear markets and the long-term risk, asset allocation and risk, our technology and platform costs, and different education sessions. The last hosted education session by BERS was in May, where we did education sessions around our private and public markets program, the investment policy statement, and the like. Actually going to skip this because this belongs in executive session. So we'll go through just one of these slides. The BERS investment policy statement defines prohibited public market investments in securities. So every year we review the securities and issuers on those lists. The board, the executive committee reviewed this last month for approval in January. Unfortunately, we were not able to get to that at the board meeting yesterday. So this is something that we will approve hopefully in February. But to give the new trustees, new executive committee members an idea, the board and public markets prohibit public market investments in 5 areas. Certain fossil fuel reserve owners, so certain companies that own proven fossil fuel reserves, so oil, gas, and coal. Thermal coal, companies that earn more than 50% of their revenue from thermal coal. Civilian firearm manufacturers, so any company that earn more than 5% of their revenue from the manufacture of civilian firearms. For-profit prisons, companies that derive at least 20% of their revenue from the operation of incarceration facilities. And then Iran and Sudan, so companies that are not compliant with UN sanctions on Iran and Sudan. I'm going to skip these for now. One thing I did want to mention, though, is that the fossil fuel investment as a whole may have a significant impact on tracking error. So just to give you an idea of and these statistics come from the Bureau of Asset Management. They track just how our divestment policies could increase our tracking error or active risk or our standard deviation around the market benchmark. And so to give you an idea, really most of our other divestments have really had no effect or very little effect on our tracking error. The fossil fuel divestments on an ex ante, so on a go forward basis from their analysis, had an effect around 74 basis points. To give you an idea about how big that is, our current, as of the last quarter that we have information, so our ex post tracking error as of 9/30/2022 was around 1.54% or 154 basis points. That gives you an idea about just how large of a percentage of our tracking error the fossil fuel investment could be going forward in comparison to what our historic tracking error has been against the public equities benchmark. Said that really quickly. I just wanted to give you all an idea that this is something that the board and the executive committee discussed in December. I'm happy to have more conversations on this, especially as we go through the approvals over the next month. So went through a lot of material there. Any questions, particularly from the new trustees, new executive committee members, excuse me.
No, thank you very much, Tony.
Thank you. So we already went through these. So we already went through the performance. I actually wanted to do 2 more things before I turned it over to Salil for the final commentary and final item on the agenda. And this actually should be updated here. I'm going to go here. And should have changed the date. This information is actually as of 12/31. To give you just a general idea around our fiscal year to date benchmarks. And so our major benchmarks over the last fiscal year, the actual highest returning asset has actually been developed market ex-US equity. I think in fact now it's probably up to around 8% or even more than for the fiscal year. U.S. equities and these high yield bonds have done very well. So as you can see here, actually the trailing year has been everybody knows the trailing year has been really difficult. But over the past 10 years, and the story has really kind of been the U.S. and everywhere else. Although this fiscal year, we've seen returns highest in Europe and developed market equities, and then high yield bonds. Still issues around in emerging markets and U.S. core fixed income. But these are our 6 major asset classes for the public markets, and just give you an idea about where we are over the past year, but really where we've been over the past 10 years. And our targets are over a long term. And so just to give you all comfort that over the long term, we have met or exceeded the required rate of return. All executive committee members have seen this. One of the things I think is really important, and one of the things that came out of our asset liability study was that how important getting to target is. And so BERS has been really aggressive in pushing forward getting to target in private equity. Has been aggressive in U.S. equity. If you compare us to the other 5 systems, we tend to have the largest equity weightings the largest weightings in most of the alternative asset classes, and generally the lowest weighting in core fixed income. So we wanted to look through and see, even with all the market drawdowns, particularly in public growth assets, was it still worth it to be as aggressive? And so we used this calendar. 6/30/2020 was when we started implementing the new policy. 12/31/2022, the latest information that we have in our investment book of record. And as you can see, the U.S. equity overweight from the allocation effect perspective is still, even with all of the drawdowns, being overweight U.S. equity added to the portfolio, and being underweight private equity was a detractor, and being overweight kind of the core bonds and being overweight cash. And so really, I think, and we'll see how the next year plays out, but our general aggression in wanting to get to our growth asset targets, I think was really important, and added value to the plan. And I think, again, the idea that the single most important thing that we can do is to get to strategic policy, to getting to our policy weights, I think has merit, given the I think the outperformance in growth assets over the long term, and because we are long-term investors.
Antonio, on that
Yes.
side, if you can go back real quick,
Yes.
just to make sure I got my axes on straight. Left to right is over under allocated, over underweight, I should say.
Yes.
And then top to bottom is actual realized returns over what period of time?
This is between 6/30/2020 and December of last year.
Okay, it's like am I doing my math right? 2.5 years?
Yeah, about 2.5 years.
Yeah.
2.5
Okay.
years.
Okay, so basically we were underallocated in private equity, real estate, infrastructure, and since those asset classes were returning strong, we lost out on returns that we would have been able to get had we been allocated at our target, had they been further to the right.
Yes, and we have to balance that, right? Because obviously, thankfully the basketball has passed, and so we have a bit more room. But we had that added constraint, right? If you're too aggressive, then you breach those bounds. And while I think if you're a different system in another state, then you just worry about it from a rebalancing perspective, right? We have to think about it both from a rebalancing and a statutory perspective, right? But I will say, we in general, we believe in growth assets, right? And that's really, I think, we believe in growth assets, we believe in in private markets, and we believe in U.S. equity. And so I think that really is the key, so that you're always riding a fine line. But I think us and police in particular tend to be a bit more aggressive when it comes to those allocations. And so we tend to have less than efficacy. We think over the long period of time, I think it will show up in the overall performance. But you are correct. You're reading the axes.
Just wanted to make sure.
Mhm.
Thank you.
Antonio, this is Tony. I have a question.
Yes.
What is the process? How far overweight do we have to be before the board would have to act to rebalance to get us into
So the Bureau of Asset
proper
Management.
allocation?
So the Bureau of Asset handles our rebalancing. I think and so certainly if we breached any, I think on, let's say the equities were going to be plus or minus U.S. equity 5%. And so that's 5. I think EM 3%. Private equity again is also, I think, 3%. So in general, you can see it as a different two ways. We have I think a lot of folks, those aren't particular. I've seen much larger bands, right? But in general, I think the both our policy and I think the practice of the Bureau has been to generally maintain target as much as possible.
And yeah, just for my education, education, I was curious about how particularly in the private equity portfolio, go about getting redemptions or rebalancing the portfolio and in some of those more sticky markets.
That again, and then we'll go through this. Go through the asset allocation exercise. Oh no, definitely. As we go through the asset allocation exercise, I think from our perspective, one of the best things about the getting 35%, not even necessarily filling that entire basket, it's that now you have more flexibility, right? So now you have you can have larger ranges, so maybe we can maintain our pacing moving forward, but then not have to start sweating when we're starting to hit that limit, right? I think that actually, because I don't know if we go all the way to 35%. I do know that being able to say we could be plus or minus 5%, so that we're able to maintain a pace that is not as lumpy, that we're not missing out on any particular one vintage. I think that's kind of the biggest thing. And so our take was that we wouldn't, we wouldn't want BAM to really sell anything, right? Like we would want to be able to maintain our and the basket clause, the expansion gives us that flexibility.
No, I was just curious about it because it seems like it's going to be an issue across the country, probably. I think, given what we're seeing in the public markets and what analysts are predicting for the potential year.
Absolutely.
So
absolutely, but one of those things, and I think this is a broader conversation, and I think this is going to be in February when we start the we'll propose to the board to start the asset allocation process. Is that potentially, right? And again, this all goes into our modeling, the work we're doing with the actuary's office, work we're doing with BAM. If we can be buyers, right, and when everybody else is kind of stuck, and again, this is a broader conversation, but if we can be buyers and not have to cut pacing as much as we thought we were going to, right? Like I think the idea, at least the last time when we had the pacing analysis discussion back in December, was that we were going to have to drop a lot, right? We were going to cut off something like $100+ million off of pacing for in PE, just as an example.
It was like 30. It was like a third of the pacing for each of the private asset classes that we were dropping.
Huge. And again, we'll run the optimization, but we'll run kind of other, I think, Salil and others will run their discussion. But I do think that maybe it won't be nearly as dire as we thought it would be just a month ago.
Hopefully, right. Super interesting. I'm sorry, I didn't mean to divert.
Oh, no, absolutely. Thank you
so much.
Thank you for the question. And then finally, I just want to say, broadly speaking, what do I think the topics are going to be for discussion for 2023? And I think there's three major categories. The first is portfolio construction in the context of net zero. Next month, John Adler, Chief ESG Officer for the Bureau of Asset Management, is going to do a presentation on the net zero implementation plan, which is essentially getting us and two of the other systems to really integrate kind of climate change and a kind of a 2-degree scenario into our portfolio construction and our asset allocation and our manager selection. So I think it brings up some very interesting discussions on how to best construct a portfolio to implement that policy. One of the things we've been kicking around is whether or not if we're going to be considering more and more security selection at the board level or the executive committee level, what does that mean for portfolio construction? Does that mean even more in the public markets, moving into passive indexation? That's one. The second is asset allocation in the context of the new basket clause. Already talked about that a bit from your question, Tony. But running that asset allocation, getting that breathing room, and then where do you spend that? Especially in the context that we are now a cash flow negative system, and so our cash flows are dropping. And then a few other research projects. One, the asset liabilities model with the Office of the Actuary. We've been working with them, and I think Merrick hopefully will be able to present something in the next month, both to the executive committee and to the full board, on our asset liability models, where we're really taking a look at an open plan growth of liabilities, and seeing which portfolios target a higher median funded ratio and not necessarily maximizing our Sharpe ratio, which is oftentimes done with the mean variance optimized portfolios that we typically use for asset allocation. Max Sharpe ratio, median funded ratio, our portfolios may not be the same. We'll do a customized ESG analytics update where we are working with some data scientists to develop some customized ESG analytics. Private equity fund optimization. I think just thinking about, there's always this tension for us between our sizing, and so how big of a check we'd like to write, versus getting into good managers that come through and are recommended, that may be below our typical amount. And so that is something that I think we want to discuss with the board on where do we find the right balance between participating in funds that may not give us the sizing that we want, versus maintaining our minimum targets and not waiving those as much. And then finally, continue to work on the defined contribution plans. We had hoped to have moved forward on the variable TDA RFP and our work on the chancellor's plan, but that's been kind of buried, and so we were going to continue to on an ongoing basis to update the executive committee on that. I know I went through a lot. We obviously, but wanted to see if there's any questions for both kind of the performance, our attribution analysis, and where I think I see the executive committee going in the at least the first quarter and a half this year.
Just looking forward to the asset allocation discussions.
Yes, I think that's by far the most important discussions to have. So, all right.
And your enthusiasm is infectious. I sincerely appreciate it.
Oh, listen, I love this stuff, man. I gotta tell
I can hear
Merrick.
it.
I'll tell Merrick that the asset liability, like we're nerding out over the asset liability model. I think they've done a great job where they're even incorporating like balance sheet information. Like it's detailed. I think if you like any of this stuff, I can't wait. Merrick and his team have done a great job of building out some stuff for us that I think could be really cool and help in that decision making.
Institutional sales guys, we zone out eventually, but we do like the we like the enthusiasm. So
Absolutely. All right.
Antonio, will we get a copy of some of the stuff that you
You will get a
showed?
copy of these presentations as soon as we log off.
Okay, thank you.
Absolutely. All right. So for the last item for today, wanted to discuss. I think this is a little bit. We actually want to discuss one of the other very big other big topics that that the board, this executive committee, and/or the full board will be making very shortly, and that is on developed market ex-US equities. It is currently a 10% target of our portfolio. So we're talking around $800 million in assets. And I think the big discussion is on currently we're the only system that has no index funds in developed market ex-US equity. We've had a big kind of round trip, so to speak, in our performance. And so we've been leaving breadcrumbs over the last few months discussing where we want to land. This is not the full discussion today. I think we will approach that over the next month, but especially for the newer trustees and the newer executive committee members, wanted Salil, who's been leading these discussions for us, to introduce the topic to you again, summarize some of the things that he's been talking about, and prep you for the discussion where we're going to have the Bureau of Asset Management, our consultants, our general consultant, Stiegel Marco, and BERS Investment Strategy discuss all of our viewpoints for you to consider. So Salil, the floor is yours.
Muted, Salil.
I apologize. I wanted to be respectful earlier, so I put on mute. So we're at a crossroads, as Antonio mentioned. We have in developed market public equities just the portfolio. That section of the portfolio is 100% in active managers, and to some degree, both BAM as well as the consultants like that format. They might be willing to budge a little bit, but it would be fractional, sort of, if so. The team at BERS, myself, Sandy, and Antonio, we see things quite differently, and I think this is why we're at this crossroads where we need to sort of present our views and then have you all sort of vote on what you want, because sort of taking the average of the 3 points of views is not necessarily a tenable sort of outcome. I'm going to just make very few comments here, just a few minutes worth, to preview the discussion in the next month or so, and we'll have a full discussion at that time. So there's 5 points which I'll evidence quantitatively at the next meeting, and the 5 points. The first is concerning excess returns in active managers in developed markets. It's been increasingly tenuous. It's been negative for a lot of fiscal year 2022. And I showed exactly what the implications are of that in a previous executive board meeting. It was on October 20th. Instead of spending the minutes sort of regurgitating that last over the next meeting, what I want to do is just in the chat, I put a link for people to refresh themselves on that presentation and for new members to sort of bring themselves up to speed. It's just 5 minutes out of that segment. It's already been pre-forwarded to that discussion on excess returns. But there's 4 other statistical points sort of to beef out the analysis. The second point, which I'll bring up next month in greater detail, is expanding on this idea that the argument for active management that falls on a back-tested review of managers would be too narrow and not, and it would camouflage the full risk exposure for that asset class, similar to what we've seen with macro forecasted performance data is to some degree not fully exposing some of the underperformance in this specific asset class or conditional upon active managers specifically within the specific asset classes and those that you're doing active management versus passive. The fourth point is that we suspect, based on the data, the excess returns, the quality of the excess returns, which I sort of showed in the link from a previous meeting, and what I'll clarify again, which goes through 10 years of data, but it works over 20 years, works over shorter time frames, is that you can have a high chance of continuing to see this underperformance over the next couple years, just as you've seen them over the last few years. And it's not something I'm saying today with the hindsight of what's happened. I started about 9 months ago, and I spoke at that time about these very same points, and the track record for the specific developed market managers in terms of just the underlying benchmark and the excess returns and so forth have been pretty mediocre. There's like 1 good month followed by 3 bad months, and it's just been kind of a wash. I think over the next couple of years, you're going to continue to see that unraveling, and I'll showcase why. And the fifth point is that by increasing passive indexing in this particular area will free up precious economic capital resources for other long-term objectives for BERS. And so those are the 5 points. And I look forward to sort of talking about this with everyone else next month. Thank you.
Thank you, Salil. I appreciate it. Like I said, so next month, we will have full presentations from Bureau of Asset Management consultant to talk about their general views on developed market equities and their rationales for a potential recommendation. And want to be clear that I think there is evidence for all 3 positions, right? And so that's why we wanted to bring it to the trustees, to have that discussion. I think, originally we were hoping that January we'd be able to have that discussion in January. I think now February is probably much more appropriate given the timing. And so, yeah, wanted to at least let you all know that there are differences of opinion, right? And at the end of the day, you are all entrusted with making that decision. And so, we'll have those kind of internal discussions, and then leave it up to you all. I encourage you all. I encourage you all to have independent relationships with all of your advisors, right? So reaching out to the Bureau, reaching out to Siegel, Marco, and getting their opinion outside of us, right? I think that is, it's a I think a bevy of opportunities to have these discussions. And again, it's a very big one, right? I think this is 10% of assets, right? So that by itself, $800 million decision. And importantly, the decision you make will have implications for whether or not this is the executive committee discusses this, but it goes to the full board, or it is an executive committee decision. So you've been trusted by your fellow trustees to be the ones deliberating on these issues. Absolutely. So Cherie, yes. So again, as you guys can probably imagine, this was the whirlwind for a lot of us of having new board member getting announced new board members 2 days before this meeting and 1 day before the board meeting. So you'll get that the entire onboarding packet from each of the from us that has the consultants, folks at BAM, asset class heads, and the like. And as soon as we are able, I think Alex and Sandy, I don't know if you guys send it out almost immediately, right?
Yeah, we'll organize onboarding calls with everyone, and we will transfer all that information. It's going to be a torrent.
Yeah.
I apologize up front. Although Vanessa could put up her contact information in the chat if she'd like. She's here. Vanessa is our Siegel Marco Advisors consultant.
Hi, good afternoon. I'm here. I'm trying to copy and paste it or put it in the chat.
There we go. Thank you.
So Antonio, we'll hear, sounds like 3 or 4 presentations on international equities next month.
Yes, we'd like to 3, and I don't think it would be a recommendation, but I do think that look, I think there's a very big difference between this and U.S. equity, right? Like I just as a both from a general performance, how much we like the beta, but then also slicing and dicing certain time periods can give you a different answer, right? Versus I think U.S. equity, any meaningful time period at this point, we've seen that indexation has outperformed almost all active managers, particularly in the large cap space, right? And so that's why I think it's one of those things where it is as much as we like all this stuff to be a science, right? And I think there's a lot of that analysis is. There is also there's some art to art may not be the right word, but there are opinions at the end of the day, right? And in addition to the data, and so that's why I think it's important for you to hear from everybody, and then come to your own conclusions.
And the point you mentioned about the full board needing to approve, this would be any managers that are new or active over, is it 250 million, the threshold?
Yes. So hypothetically, right now, your 2 managers, Bailey Gifford and Spruce Grove, let's say you wanted to make a change in large cap to another active manager, they're going to be of a size where it would exceed the threshold to be approved by the executive committee.
Yeah, okay. Sounds good.
All right. That is everything. So that's the last item for discussion. Now it's 10 minutes before the end of the meeting, so a little bit better than the board meeting. So if there's anything else to discuss, otherwise, looking for a motion to adjourn.
So moved, Russ.
I thank you, Russ. Second.
Second from John.
All right. Any final discussion? All right. All those in favor, please say aye.
Aye,
Hi,
Russ.
Cherie.
Hi, Tony.
All right. Any opposed? All right. We are adjourned. Thank you. The next executive committee meeting scheduled for February 16th at 1 p.m. We'll send out an invite shortly. John Matterich, do you have a second?
Thanks, folks.
Sure.
Can I get you for like 2 minutes?
Yeah, sure.
Well, what's the best number to reach you at? Oh, can you put it in the chat?
Just stay on here and let everybody go?
Yeah, that'll work. That works way better.
Okay.